There's a mortgage where the lender never asks what you make. Not a loophole, not a favor. Federal law just doesn't require it on this loan. No pay stubs, no W-2s, no tax returns, no debt to income ratios. The lender looks at what the property rents for. That's the qualification. It's called a DSCR loan. And once you see why the rules are different on it, every weird thing about this loan starts making sense. The prepayment penalty, a normal mortgage, isn't even allowed to charge you. The disclosure package, you never get. And the fact that somebody with a six-figure write-off gets approved while somebody with a six-figure salary gets told no. I'm David Lurvey. I'm a licensed mortgage loan officer, MLS 410420, and I've been doing this for over 20 years. Today, I'm giving you the whole thing. What this loan actually is, the one number it runs on, who it is built for, what it really cost you. And one $300,000 rental runs start to finish from a down payment to approval. Quick favor first. If this is helping, tap the like and subscribe if you want more of these. Okay, here's the deal. Start with the core idea because everything else hangs off it. A normal mortgage qualifies you. The lender pulls your credit, pulls your job history, reads your tax returns, adds up every payment you owe and divides it by what you earn. That's your debt to income ratio. Too high, and the answer is no. Doesn't matter how good the deal is, the house isn't what's being judged, you are. A DSCR loan flips that. It doesn't qualify you, it qualifies the property. And the only question that actually matters is whether the rent covers the payment. If the property can pay for itself, the loan works, almost regardless of what your tax returns say about you. DSCR stands for Debt Service Coverage Ratio. One number and the whole loan rides on it. Now, let me tell you who this actually rescues because it's probably not who you're picturing. Say you own a business, you do well, $200,000 comes through the door, and your accountant's doing exactly their job you're paying them to do. Writes off the truck, the home office, the equipment, and the travel, and the depreciation. By the time it hits line 11 of your tax return, your income is $41,000. You go apply for a rental loan, the lender doesn't see your $200,000. They're not allowed to see that. They see the $41,000, and $41,000 of income doesn't support a rental payment on top of the house you already live in. So you're denied. And here's the part that stings. You got denied for being good at running a business. Same thing hits the person who's already got 3 or 4 rentals. Every one of those mortgages lands on your debt side. Only 75% of the rent counts on your income. So each good rental you buy makes the next one harder to get. The math turns on you right when you're winning. That is the villain in this video. Not bad credit, not a bad deal. The ratio that doesn't describe your life. So here's the comeback. And it fits on one line. Your DSCR is the property's monthly rent divided the property's monthly payment. That's it. Rent on top, payment on the bottom. Now, when I say payment, I don't mean mortgage payment. I mean the full cost of owning the place. Lenders call it PITIA, principal, interest, taxes, insurance, and association dues. Your HOA is there as well. And all 5 together and that real number that has to be covered. Quick example, a rental brings in $2,000 a month, full PITIA is $1,600. 2,000 divided by 1,600 is 1.25. That's the DSCR. And notice what just happened. Nobody asked what you do for a living. The property answered the question itself. Now, why is a lender even allowed to do that? Because on a normal home loan, they're not. Since 2014, there's a federal rule called Ability-to-Repay. It lives in 12 CFR 1026.43, and it says a lender making a mortgage has to make a reasonable good faith determination that you can actually afford the payment. Verified income, verified assets, documented. The rule is why your loan officer keeps asking for one more bank statement. But read the first line of that rule. It applies to consumer credit secured by a dwelling. Rental property isn't consumer credit. And that's not my opinion. 12 CFR 1026.3 exempts credit extended primarily for a business purpose. And the official commentary spells it out. Credit extended to acquire, improve, or maintain rental property that is not owner-occupied is deemed for business purposes. Not may be treated, deemed is a category. So when you borrow money to buy a house, somebody else is going to live in it. You're not buying a consumer. You're not a consumer buying a home. You're a business buying an asset, which means ability to repay doesn't apply to you. RESPA doesn't either under 12 CFR 1024.5. This is a business purpose definition. That's the actual reason this loan exists. It isn't a trick and it isn't subprime. It's a different aisle down the store. And one thing to know, because people get caught by it, that's commentary has a limit. If you plan on using the property yourself for more than 14 days in the coming year, it stops counting as non-owner occupied. And this rule doesn't apply to you. So the beach house you're going to use for a month every summer is not this loan. Quick break because today's video is sponsored by me. If you're running this math on an actual property, stop guessing. Book a free call and I'll run your real deal with you. What it cash flows, what a lender will and won't do with it before you're under contract. Want to run it yourself first? My free DSCR calculator is linked down below. It's on my website. Scan the code on the screen or grab the link in the description. All right, let's get back to it. So what does your number actually mean once you have it? Think 1.0 as the break-even line. At exactly 1.0, the rent covers the payment to the dollar, nothing left over. Above 1.0, the property makes more than it costs. Our example at 1.25 means the rent comes in at 25% above the payment. Below 1.0 means the rent doesn't cover it and the difference is coming out of your pocket every month. Most DSCR lenders want to see at least a 1.0. A lot of them hand you their best pricing once you're at 1.2 and 1.25 and higher. And some of them will go under 1.0. You'll see programs written down to 0.75 and even what's called a no ratio, where the property doesn't fully cover itself on paper at all. Those exist, but they just cost a little bit more, bigger down payment, stronger credit, higher rate. The rule's pretty simple. The higher your ratio, the cheaper the money. Now, who's this really for? Self-employed people and business owners. That's the $41,000 problem I just walked you through. Your returns don't describe your life, and this loan doesn't ask them to. Investors who want to keep going, Fannie Mae has a hard ceiling written into their selling guide. Section B2-2-03 is 10 financed properties. That's the wall, and you hit it. Conventional financing is done with you. DSCR lenders don't have that agency cap. Each property stands on its own, so property 11 is the same conversation as property number 2. Anybody buying in an LLC because the loan is business purpose, closing in the name of your entity is normal here instead of being a fight. And people who want to move, no income documents means way less paperwork and usually a faster close. In a market where the seller's looking at 3 offers, closing speed is a real bargaining chip. Okay, now the part I'd want somebody to tell me. This loan has real trade-offs. I care about this one enough that I wrote a book on it. It's called DSCR Loans Made Simple. It's on Amazon and the link's below if you ever want the long version, but you don't need it for this part. Let me just give you all 5 straight. 1, it is investment property only. You cannot live in it. You cannot buy this home to live in at all. If you want to live in it, you're looking at a conventional FHA, VA, or USDA. And if you're hoping to live in one unit of a small multifamily and rent the others, that's house hacking. That's an FHA loan with a much smaller down payment, and I've got a whole video on that. 2, more money down. Most programs want 20 to 25%. There's no such thing as a 3% down DSCR. 3, reserves. Lenders want to see several months of payments still sitting in the bank after you close. 6 months is common. They want to know you can carry it through a vacancy. 4, prepayment penalties. And now you know exactly why. On your own home, Regulation Z barely allows one at all. And where it does, it caps at 2% for the first 2 years, 1% year 3, and after 3 years, it can't be charged at all. Business purpose loans sit outside of that. So a DSCR loan can absolutely carry a 5-year step down, 5, 4, 3, 2, 1 prepayment penalty. That's not the lender being sneaky. That's the same exception that got you approved, pointed the other way. You can often buy it down or buy it off. You just have to ask, and it's a price. 5, less consumer protection generally, no loan estimate, no closing disclosure with most lenders. Not because somebody's hiding something, those are consumer mortgage forms. And this isn't a consumer mortgage, which means you have to read the term sheet like a business owner, not like a home buyer. Nobody's handing you a standardized comparison page. Now, let me kill one myth because the internet's been repeating it for a decade. You'll read everywhere that DSCR loans cost you 1 to 2% more in rate. That is not true. It once was, it is not the market today. DSCR pricing now runs right in the neighborhood of what a conventional loan would on the same rental that would cost you. And read that carefully because both of those are investment property rates. Neither one is the rate on the house you live in. An investment property prices above an owner-occupied loan, always. That's the real comparison, and once you're making it, the DSCR premium mostly isn't there anymore. You're not paying a penalty for skipping the income documents. You're paying the going rate for a rental. All right, let's run one all the way through. $300,000 rental, single family, you put 20% down, which is $60,000, so you're borrowing $240,000. 30-year fixed, and I'm assuming an example of, we'll just call it 7.25% interest rate. Principal and interest comes to about $1,637.22 a month. Property taxes, let's figure 1.1% a year. That's $275 a month. Landlord insurance, 0.8. That's $200 a month. We'll just say this property has no HOA. Added up, your full PITIA is about $2,112.22 a month. Now, the only question left, what does it rent for? The appraiser fills out a rent schedule, and let's say market rent comes back at $2,550 a month. $2,550 divided by $2,112.22, that's a DSCR of 1.21, approved comfortably. And notice, we never once said the word salary, but I want to be honest with you about what the 1.21 is and isn't. The lender sees rent minus payment and calls it $437.78 a month of cash flow. That's the lender's math. It's not your math. Your math has vacancy in it, repairs, roof you're going to replace someday, and a manager if you use one. I run the numbers all the way to the bottom in a separate video, and I'd watch it before you buy anything. DSCR is the approval test. It was never a profit test. Last thing, what if your deal comes in short? You've got levers, and they're more real than people think. Put more down, smaller loan, smaller payment, higher ratio. In our example, getting from 1.21 up to 1.25 takes about $10,500 more. Now, you know the price of where the tier is without guessing at it. Shop the rent to the price ratio, not the price. A cheaper house in a weak rental market fails. A pricier house where rents are strong passes. The relationship is local and it's the entire ball game. Ask about interest only. Some programs allow it and lowers the payment on the bottom of the fraction, which lifts the ratio. You're just not paying down principal while you do it, so know what you're trading. And if it's a short-term rental, a lot of programs will let you qualify on the projected nightly income instead of long-term market rents, which can be a much higher number. Point is, picking the right property and the right structure isn't something you do before you qualify. It is how you qualify. Let me put the whole thing back together. A DSCR loan qualifies the property, not you. The property, or the number is the rent divided by your full PITIA payment. Above 1, it pays for itself. Most lenders want a 1.0 and reward 1.2 and higher. The reason it works this way is that the rental is business purpose credit and the ability to repay rule doesn't matter. That's what buys you the no income documents approval, and it's also what buys you a prepayment penalty and missing disclosures as well. Same door, both directions. It's investment property only. Expect 20 to 25% down in a few months of reserves. And don't believe the 1 to 2% rate story anymore. If your tax return has been the thing standing between you and your rental property, this is the loan that stops asking about that. It lets the property prove itself instead of making you prove yourself. I'm David Lurvy. This is education, not personalized advice for your situation. Go run your numbers. I'll see you in the next one.